So I think na inyo. So what I can show you now is the October 2022 nga exam. Okay, so on my end, I will focus on those topics nga wala ninyo naagian last in your curriculum. Okay, so example anto katong mga different financial markets. So and by the way, sa based on the 2022 exam, so nawala na ang management consultancy nga kuan nga coverage. Okay, but that's on October 2022. So I'm not sure with October 2021 nga mga topics. Okay, so presenting again the syllabus. So you always make sure that all the topics nga inyong tunan uh, or inyong makover is really on your koan in your based on the syllabi or the table of specifications for the exam or sa examination date kung asa mo mo take. Like for example, if it's in May, so you look for the May 2020 2021 nya syllabus. Then if it's October, so October 2021. So for financial management, these are the following topics. So the nature, purpose, and the scope of financial management, the role of financial managers in the investment, operating, and the financing decisions. Then you have the financial management concepts and techniques for planning, control, and decision making. So you have the FS analysis, you have the working capital management, capital budgeting, and our focus are the second meeting and third meeting. So we are going to discuss these two. So the risk and the leverage. Okay, so you have capital structure and long-term financing decisions. And in the future, I'm not sure kung naana ba ni sa 2021 niya syllabus, but based on the October 2022, apilo na ang financial market. Okay, so financial market, so money markets, the types of money market instruments. And then you have the capital market, so fixed income market. So example, anak ato mga bonds. So you have the stock market. Okay, so I think you also need to be familiar with the Philippine Stock Exchange. So in regards to financial market, so I have already discussed this in the last semester sa mga undergrad. So I will just give you the link kung asa na ko gi-upload ang kuan. Ang discussion ako about the financial markets. Although we will still discuss pero basin Mas may nang mahatag na nako sa inyo daan. Okay. So we're done with economics. Okay, so these are the three coverage for the uh, management accounting, the economics, financial management, and MAS or the uh, management accounting. So for management accounting concepts and techniques for decision making, so do not forget to study these topics, mga quantitative techniques, so probability analysis or getting the expected value, the decision tree diagram, and linear programming. So linear programming could be a graphic method or the algebraic method. Okay, so let's begin the discussion for the capital structure. Okay, so so as we all know, all assets are either financed by the either through borrowings or liabilities or from our equity, okay, or from the shareholders. So that's why we have the equation assets equals liabilities plus equity. Now, when we say capital structure, this refers to the mixture or the composition of your financing. So how much unsay proportion sa liabilities, unsay proportion sa equity nga nag-finance sa ato ang assets. Okay, so of course those financing is not free, 'di ba? It's with a cost. Okay, so every time you borrow, you will incur interest expense. And then kung mag-issue po kag stocks, na po na siya corresponding nga cost because you have to pay dividends and napay mga other cost in the issuance. So we say leverage. So from the root word nga lever, so it's a multiplier of force. So multiplier of effects. So it's a machine or it's a tool that with a small effort you can achieve the output is the output is greater. Okay, but leverage can also it's can either be a bad thing or a good thing depende sa situation sa business. Kay kung naay net loss, mosamot ang imong net loss with the leverage. But if the situation is normal or good, it will increase your profits. So under this chapter, so we have the following subtopics: the business risk, the operating leverage, financial risk, the optimal capital structure, and lastly is the capital structure theories. So what is business risk? So the business risk is the riskiness inherent in the firm's operation if it uses no debt. So even if without wala by financing, so it is really that risk is already inherent in a business. So as all types of business have different business risks. So na mga business nga risky such as mga startups or mga technological companies na apoy mga business nga medyo stable pero dili na naka uh, stable pod dili pod ina naka dako ang returns. So so as you can see in this graph, so if you can see this shape, okay, so kanang very steep nga mountain figure or mountain nga mura siya bell, okay. So uh, that is low risk, okay. So to get this, so you have to compute for the standard deviation of the return on invested capital for that business. So a low standard deviation will look like this, getting very steep. So it indicates nga low ang risk. So as we know, kung taas ang standard deviation, meaning there's a high possibility nga ang actual result will not be the same with our estimated result, okay, or estimated returns. So that's why it's very steep, because the actual result is dili kayo na ka uh, lahi sa estimated niya return. Okay? Okay, most probably we can forecast more accurately sa mga low risk business kaysa sa mga high risk business because of its high uncertainty. Okay? So E stands for expected, then ROIC stands for return on invested capital. Okay? Return on invested capital, so it does not refer only to shareholders' equity, but also to the borrowings or the proceeds used to invest in the business. EBIT, so earnings before interest and taxes. So the commonly used measure of the business risk is the standard deviation of the return on invested capital. So it's important that you also know how to get the standard deviation. So what are the factors that determines the business risk? So first you have the competition. So if the business has a lot of competitors, it increases the uncertainty, thus increases the risk or the ability of the business to survive the competition or survive the business. Of course, kung isa ra ang competitor, so low ang business risk. Or what if that the market structure is monopoly, so the business risk is very, very low. Another factor that contributes to the business risk is the uncertainty of demand or the sales. So if the sales is not stable, so lahi-lahi ang sales every month, or there are times nga wala because it's seasonal, so that increases the risk. Whereas those businesses that have a stable sales demand, okay, so that lowers the business risk. Uncertainty about output prices and uncertainty about cost. So kani sila is usually mag-uban. Okay? So usually we increase the prices because we also have uncertainty about the raw materials that we buy, or the even the labor cost can also contribute to the increase in the output prices. So the uncertainty about cost, like for example, ang raw material nga gigamit is heavily dependent on oil. Okay, so especially mga airline industries. So uh, they ex uh, they import the oil because of course mas cheaper man sa gawas ko kaysa diri sila mo palit. So and then they need um, a lot of that raw material. So as we know, the oil prices are very volatile. So dili siya fixed. So most of the time magsige na siya saka decrease saka decrease. So it causes uncertainty about the cost of their goods, or the cost of their raw materials. So in turn, the businesses will have no choice but to increase the prices of their goods. Okay? So if there's uncertainty about the prices and the uncertainty about the cost, so the higher the uncertainty, the higher the business risk. And the opposite, of course, will lead to lower business risk. Product obsolescence. So there are products that dali ra kayo ma-obsolete, or dali ra kayo or the market dali ra ma-change ilang preference, okay, or ilang taste for that product. So For example, sa mga gadget nga mga products, so medyo paspas ang iyang obsolescence. Okay, so bago pa kay nag-release og mga bago nga model sa iPhone, wa pa naman ang isa ka tuig na napoy gi-release nga product. So their products are very fast ang ilang obsolescence. Napoy products nga dili inana ka paspas ang ma-obsolete. Okay? So kung paspas pa obsolete, of course, it increases the business risk. If dili kayo paspas, lowers the business risk. Foreign risk exposure. So if the business is exposed internationally, let's say the raw materials nga palit niya come from outside or from outside the country. So na siya exposure sa foreign risk. So especially with regards to the exchange of the currency. And another reason nga nung ma-expose ang business sa foreign risk is probably dito ang iyang market or dito siya nagbaligya sa iyang goods and services. So high foreign risk, foreign risk exposure, high business risk, low foreign risk exposure, low business risk. Regulatory risk and legal exposure. So there are businesses that are heavily regulated by the government because it involves the public safety, perhaps, or the environmental protection. So such as mga mining, even mga investment companies are heavily regulated. So even at this time, 'di ba, sa pandemic, so because there are a lot of businesses nga dapat sa temporary shutdown or temporary closed because these businesses are kanang prone to uh, kumbaga physical contact, okay? So such as kato mga massage, mga parlors, okay? Even malls, okay? Dugay sila naka-open because the IATF um, orders those types of businesses nga mo temporary shutdown lang sa. So those businesses are uh, nasa are naay regulatory risk and legal exposure. So of course, the less regulatory risk and legal exposure will lead to lower business risk. And lastly, you have the operating leverage. So when we say operating leverage, it's actually the use of the fixed cost. Okay, so there are businesses that are capital intensive. So we say capital intensive, they produce their products nga gamit ang mga machines. Okay? Gamit ang machines. And most of these machines, di ba, they will incur depreciation. And depreciation is a fixed cost. Okay? So the higher the fixed cost, the higher the operating leverage. And the lower the fixed cost, the lower the operating leverage. So nganong risky man pagtaas og fixed cost or dako ang amount sa fixed cost. Okay, so again, all the leverages na siya two sides of the coin. It can result into bad or it can kung profitable ang business, it will increase further the profit. If the situation is bad, it aggravates the situation. So kung nakay net loss, samutan niya imong net loss. So ngano man, because in times of good economy or normal situation, remember ang fixed cost mo gamay na siya as the sales demand increases. Diba? Ang fixed cost per unit mo gamay even though the sales demand increases. However, pag dili mo decline ang sales, ang units, the fixed cost will still be the same. Okay? It's in fact mutaas gani ang fixed cost per unit pag mo decline ang ang sales. Okay? So remember when we compute for the contribution margin, I mean the break-even point. So 'di ba, if you recall, the formula is fixed cost over the contribution margin rate. That's for peso, and fixed cost over contribution margin per unit if we want to get the break-even units. So kung taas imong fixed cost daan, of course, taas ang imong break even. Okay? So ceteris paribus, kung low ang imong fixed cost, low pod ang imong um, low pod ang imong kailangan i-break even. Okay? So if the business has a high operating leverage, it contributes to high business risk. But as we know, all risks na na siya uh, accompanied by return. So the higher the risk, the higher the return. So what is operating leverage and how does it affect a firm's business risk? So as I explained gaina, it's the use of the fixed cost rather than the variable cost. So ang nakahinot mo gud sa variable cost kay let's say there's a temporary shutdown, you will not incur those variable costs. Whereas the fixed cost maski pag mag-temporary shutdown ka diha, you will still have to pay for those fixed costs even if it's not working or it's not you are not using those machines, you are still incurring fixed costs. If most costs are fixed, so they do not decline even if the demand falls. So the firm has a high operating leverage. So more operating leverage leads to more business risk. Therefore then, a small sales decline, so gamay lang nga decline ana sa sales, it will cause a big percentage of profit decline. So small sales decline, uh, it will lead to a bigger profit decline. So kaning nasa right, this is the high operating leverage. So as you can see, taas iyang fixed cost against the left side. So ubos ang iyang fixed cost. So dali ra ka maka-profit aning sa low operating leverage kaysa sa high operating leverage because of the lower number of units that you are going to sell to break even and for you to profit. Now, what happens if the variable cost will change? So what happens if the variable cost will change? So if you can recall how we get the contribution margin, so if mutaas ang variable cost, okay, if mutaas ang variable cost, so no other factors involved, so kana ra ang nag-change, it will lead, kung peso ang imong gipangita, it will lead to kung higher ang variable cost, it will lead to higher contribution margin. Ano? No, kung higher ang variable cost, it will lead to a lower contribution margin rate. Okay? So what happens if there is a um, okay, so what happens if you have a lower contribution margin rate? So let's say 100,000. Kailang, so di ba, pag mataas ang variable cost, it will lead to lower contribution margin rate. So say the fixed cost is 100,000. And then the other say 40% ang original. So, now pagtaas sa variable cost, of course, it will lead to a contribution margin decline because remember, the sales is 100%. So, ang variable cost, kung mataas siya, so ang mabilin for the contribution margin will be lower. So, our original break-even point, okay, so the original break-even point, if you divide the 100,000 by 40%, so you will need only 250. Okay? So, magutay pen nga sakto. Okay, so 250K. Now, let's you kumutas ang variable cost, let's say mahimo na lang 20% ang CMR or the contribution margin rate. So divide by 20%. So say result ani, so what is the break even? So mutaas ang imong break even point. So it means the business risk increases. Okay, so the business risk increases when the variable cost will increase. Whereas kung mogamay imong variable cost, it will lead to a higher contribution margin rate. Therefore, a high contribution margin rate will lead to lower break-even point. Okay? So it will lead to lower break-even points. Therefore, we can say that higher variable costs will lead to lower business risk. Okay, so typical situation. So we can use the operating leverage to get the higher ROIC. So but the risk also increases. Okay, so for those businesses that have a low operating leverage, so money ang PERMA, so it has a steep, very steep nga figure, very steep nga bell. So that's an indication of a low operating leverage. And the high operating leverage will have a wider nga mga differences. That's why gabi ka wide. So it indicates it's a high operating leverage business. So ROIC, so it is the measure of the after-tax return that the company provides for all its investors. So the ROIC doesn't vary with the changes in the capital structure. So again, the invested capital does not only refer to equity, but even from also from the liability, okay, or from the debt financing. So let's say the total invested capital is 2 million, and then the earnings before interest taxes is $400,000, and the tax rate is 40%. So you have an after-tax rate of 60%. So our initial ROIC is 12%. So after discussing the operating leverage, so the other risk nga i-consider, so every time we finance, so every time nga mangita taog capital to finance the business is the consideration of the financial risk. Okay? So although na a financial risk, but it can also lead to a financial leverage. So again, when you say financial leverage or leverage in general, so in good or normal condition, it will help the business gain higher return. I mean, gain higher ROE or return on equity. However, in bad situation, it will aggravate the ROE, or it will significantly decline the ROE. So when we say financial leverage, we're talking about debt financing or liabilities. Okay, so now you may be wondering anong na ay preferred stock. Okay, so the preferred stock in form is really an equity component. So part yun na siya sa equity component. However, in substance, the preferred stock is treated as a liability because the preferred stockholders have priority sa paghatag og dividends, and somehow ang dividends nila is regular ang pagbayad. Okay, so it's part of the contract sa preferred stockholders nga na sila regular dividends nga madawat. So in substance, the transaction looks like a creditor and debtor relationship. That's why when you talk about financial leverage, it's the use of debt and the preferred stock, especially sa mga preferred stock nga cumulative. So financial risk is the additional risk concentrated on common stockholders as a result of financial leverage. So ang business na naman siya inherent nga risk. So kung dungagan pa gid nimog liability, it increases the risk due to financing. So we call that financial risk. So every time you add liability, remember, gamay na lang ang portion or mugamay ang portion sa net income nga mapadulong sa stockholders to be paid as dividends. So the business risk, so as we have discussed gaina, it depends on the business factors or the factors. Most of them are outside the control of the business. So such as the competition, the product obsolescence, and operating leverage. While the financial risk depends only on the types of the securities issued. So when we say securities, it can refer to debt or equity securities. So more debt securities, more financial risk. So the business risk concentrates on the stockholders. So because of the financial risk, nadungagan ang risk nga sa investment sa stockholders. So let's have an example of two firms. One firm is naay liability, ang isa walay liability or walay debt. So they have the same operating leverage, the business risk. So differ lang gyud sila sa liability. So let us examine what is the effect of the financial leverage. So it's a firm U. So U stands for unleveraged or unlevered. So when we say unlevered, pasabot ana, wala na siya liability. Firm L or leveraged firm or levered firm. So kana siya nga mga firm na ana sila liability component. So they have the same invested capital, $20,000, and the tax rate is 40%. For Firm L, nag-borrow siya og 10,000 and an interest rate of 12%. So these two firms only differ with the capital structure. One firm has no debt while the other firm has a liability. So we have three scenarios. You have the bad, the average, and good. You have the probability. So 25% chance of having a bad situation, 50% chance, average or normal condition, and 25% good situation. So EBIT or the earnings before interest and taxes. For bad, you have 2,000. Average is 3,000. Good is 4,000. Right? So the EBT or the earnings before taxes is the same with the EBIT. It's because this firm has no interest expense. So you have the taxes, 40% of those EBT, and the net income for bad situation, for bad economy is 1.2, for average is 1.8, and for good is 2.4. So for firm L or the leverage firm, so same probability. Now they only differ with the interest. Okay. So ang interest is the same regardless of the situation. At 12% say at 10,000, so you have 1,200 each. So in each scenario, you have to incur 1,200. However, the good thing about having a leverage is that the taxes is lower compared to a firm we don't that doesn't have a tax. I mean, doesn't have interest. So medyo ubos ang taxes, or there is a tax saving if there is a liability, because we have to deduct the interest sa para makuha ang net income. However, the bad news is the net income is now lower. Okay, so ngayon na 1,218,24, around it's 480, 1,080, and 1,680. So you say so we pasabot ani, if there is a net interest, it will decrease our net income nga absolute amount. Okay, not absolute amount. However, this absolute amount should not be kumbaga dili kani ang mo'y final nga uh, gamiton to present to the investor, otherwise ma-misled siya, because we have to use the ratio para gyud makita gyud unsa gyud ang actual picture or actual nga uh, scenario. So we have three different ratios. So we comparing the leveraged and the unleveraged. So kaning sa taas mo ni ang mga unleveraged firms, sa ubos mo ni ang mga sa leverage nga firm. So return on invested capital, regardless whether firm U or firm L, they have the same result. Okay, so 6%, 9%, and 12%. So same with firm L, 6, 9, and 12. Okay, so remember the invested capital does not mind whether the financing comes from equity or debt. However, for return on equity, so of course the unleveraged kay tanan man gi-financed by equity or shareholders equity. So they have the same sa ang ROIC ug ROE is the same. 6, 9, and 12. For times interest earned, so that's EBIT over the interest expense. So of course it's undefined because interest expense is 0. Now, diri ang changes. So diri ang changes. Okay, so if, compare the unlevered firm and the levered firm. So pag bad ang situation, so kung wala to'y utang, walay interest, the ROE is 6%. But if the situation is bad, the ROE is 4.8. Okay, 4.8%. So however, pag situation is normal, so if walay financing from liability, 9% lang iyang ROE. But on average, it's 10.8. And then for good situation, so medyo taas-taas gyud. Okay, dako gyud ang difference. Okay, so it will be 16.8 ang ROE against ROE nga 12% kung wala siya financing. Okay? So muna akong giingon nga ang lever, it can either samutan niya imong situation kung good, mas mo better pa gyud ang performance, but if the situation is bad, it will also aggravate the situation. times interest earned, so 1.7 times, 2.5 times, and 3.3 times. Okay, so remember nga nung inani ang result, it's because the equity is now lower. Okay? Although niubos ang atong return or ang net income, but niubos man sad ang atong equity. Because some of the assets are now financed by the liability. So kung ubos ang denominator, mo ni siyang inani ang result. So so risk and return for leveraged and the unleveraged firms. So E stands for expected value. So so to recall giun sa pagkuha ang mga expected value, so you just multiply the probability sa iyang uh, result. So if it's bad, so i-multiply nimo sa bad. So let's say 25%, multiply nimo ang ROIC sa bad plus 50% sa normal multiplied by the ROIC of the normal plus 25% multiplied by the ROIC of the good situation or good economy. So these are the expected values. For ROIC, so you have 9%. For firm L, 9%. So walay difference. For the return on equity, however, so si firm unleveraged is 9%. But for firm L, na siya expected value nga 10.8%. Okay? So taas ang iyang expected value. So, risk measures. So for risk measures of ROIC and ROE, so for unlevered firm, same ra ang standard deviation. But for firm L, 2.12% ang ROIC. However, mas taas ang risk because it is now 4.24 compared with the firm U nga 2.12%. So mo na tong giingon nga taas lagi ta og expected value or taas tag return, but it is also accompanied by higher risk. Okay, so for leverage, the ROIC must be greater than the interest expense. Okay, so kaning RD, that's mo ni siya ang symbol for the cost of debt, okay, or return of debt, okay, multiplied by the after tax rate or 1 minus tax. So interest times after tax rate. So dapat mas dako ang ROIC para mutaas ang ato ang ROE or return on equity. Otherwise, um, the leverage will depress the income. So samutan niya imong net loss pag inani ang situation. Mas taas ang interest rate after tax kaysa sa ROIC. As debt also increases, so the times interest earned also decreases kay ang EBIT is the same, unaffected, but ang imong denominator, ang interest expense nagsigi og saka. So kung magsigi saka ang denominator, it will result into a decrease of the times interest earned. So ato na siya makita in the succeeding examples. So return on invested capital, as our conclusion, is unaffected by the financial leverage. L has higher expected ROE because the ROIC is greater than the cost of debt after tax or the cost of debt. L has much wider ROE and earnings per share. So mas dako ilang ang EPS ni L because of the fixed interest charges. So we also know that the higher expected return is always accompanied by a higher risk as measured by the standard deviation. Okay, so now let's move to the optimal capital structure. So when we say optimal, so it's the ideal capital structure, or it's the capital financing that will give us the lowest cost of capital. Okay? So ang pinakaubos og cost of capital. But since you have different types of financing, so we are going to compute for the weighted average cost of capital. So kung kinsa to'y capital structure that will produce the lowest WACC or the lowest weighted average cost of capital, then that is the optimal capital structure nga dapat i-maintain sa business in their financing decision. So not only the minimum WACC, but it is also the capital structure that will maximize the stock price or the market the value of the stock. So trade-offs trades off higher ROE and EPS against the higher risk. So more financial leverage, it will increase to higher ROE and earnings per share. However, it is accompanied by higher risk. So even though we are benefiting from tax savings due to the interest expense, it is also offset by the related cost. So katong interest expense pod, i-deduct po nato sa ato ang earnings before interest and taxes. So the target capital structure is the mix of debt, preferred stock, and common equity with which the firm intends to raise capital. So dili basta-basta mag-financing because it has an effect to the stock price or the cost will increase also. So why do the bond rating and the cost of debt depend upon the amount of debt borrowed? So as the firm borrows more money, the firm increases its financial risk, causing the firm's bond rating to decrease and the cost of debt to increase. So for example kani. Okay, so according to the katong gikuan gaina nga the more money we borrow, the more nga mo decrease ang bond rating and the more nga mosaka ang cost of debt or the cost of debt financing. So 250,000 kung magbaro kag 250,000, the bond rating is double A. Pero as we increase our borrowings, mo downgrade ang bond rating, but with the cost of debt will increase. Okay, so for unlevered firm, so we know that that is the unlevered firm is not really the ideal capitalization. So para mo decrease ang cost of capital, we need to balance financing from equity or from liability. So if the firm would want to recapitalize or change the capital structure, so mo undergo na siya ginatawag nato recapitalization. Okay? So it's either you issue new debt or you purchase uh, or the proceeds are used to repurchase stock. So especially if it's unlevered and you want to issue stock, you issue debt. So ang buhaton ana para ma-decrease ang equity is to repurchase some of the issued stocks. So mapadulong siya sa treasury shares. So kung mangutang ka, you will use the proceeds to buy your stocks, okay? Your issued stocks. So the number of shares repurchased is equal to the amount of debt issued divided by the price per share. So let's analyze the recapitalization at various debt levels and determine the earnings per share and TIE at each level. So at D0, meaning wala siya liability, so the EPS, so ang pag-compute sa EPS is basically the net income after tax. Okay, so net income after tax divided by the shares outstanding. So kung tong 2 million, So 2 million man to invested capital, that is equivalent to 80,000 shares. Okay, so 80,000 shares. Now, if you want to get the price of each share, okay, so if you want to get so that's 2 million, you divide it by the 80,000. So that's how you will get the market price per share. Okay, so so you have 25 pesos per share. Okay, so since wala tayo liability, zero atong liability, so therefore, our earnings before interest and taxes is mauna na siya ang atong i-multiply sa after tax rate. So the tax rate is same 40%. So this is ang result ani is 240,000 divided by 80,000. So you have 3 pesos as your earnings per share. And times interest earned, of course, wala, undefined because we don't have interest expense. Now, how about if we borrow 250,000? So what are the changes sa ato ang EPS and TIE if we borrow to 50,000 and then the interest or the cost of debt is 8%. So we have already computed the market price per share. So we have to recapitalize. So diba total invested capital is 2 million. Then since we borrow to 50,000, so pila ka shares ang kailangan na to i-repurchase. So 250,000 divided by 25, the market price per share. So you have to repurchase 10,000 of the issued shares. So computing for the EPS or earnings per share. So you get first the interest. So we already know the EBIT and the after tax rate. Now i-deduct na to ang interest expense. So 8% times 250,000. So you have uh, so I think that is 20,000. Okay, so yes, 20,000. So 400 minus 20,000 is 380,000. So 380,000 multiplied it by 60%. So you have 228,000. So 228, i-divide nimo sa 70. Anong na minus og 10,000? Because you repurchase the shares. So ang mabili na lang nga outstanding is only 70K. So that result into 3.26 nga EPS. So nitaas ato ang earnings per share. And the times interest earned is now 20 times. So EBIT 400, interest expense is 20,000. So what if we further increase our liability to 500,000? So you have to compute first pila ang shares nga dapat i-repurchase. So you have to repurchase 20,000 shares. Computing for the EPS of the new recapitalization. So 400,000. So the cost of debt is now 9%. So 9% times 500,000 mo na i-deduct sa 400,000 times the 60% times the 60%. So result ana niya, i-divide nimo sa difference of 80,000 minus shares repurchased niya, 20,000. So the new EPS is now 3.55. Times interest earned. So nitaas ang interest expense. So kung gain na 20 times, karon it's only 8.9 times. So magkagamay ang TIE or times interest earned, magkataas ang financial risk. So what if we increase further to 750,000 and the cost of debt is 11.5%? So shares repurchased 30,000. The new EPS, so same gapon, gay na 3.77, and the times interest is now lower, 4.6 times because the interest expense nagkataas. Then you have the 1 million. So EPS is 3.90 and TIE is 2.9 times. So so based on those, so we can say that the higher the financing from debt or from liability, it will cause the EPS to increase. However, for the times interest earned, it will decrease. So what effect does more debt have on firms' cost of equity? So dili lang cost of debt ang makuha, but it will also have an impact to the cost of equity. So if the level of debt increases, the firm's risk increases. So we have already observed the increase in the cost of debt. However, the risk of the firm's equity also increases. So dili lang business risk ang maka-increase sa ang gina-absorb sa mga shareholders, but also the financing risk. So for their cost of equity, it will also increase. So RS is the symbol or mo ni siya ang nag-denote sa cost of equity. So we have already computed for the cost of debt. Now, for us to quantify a new cost of equity, okay, to determine the increased cost of equity due to financial leverage, we can use the Hamada equation. Okay, so the Hamada equation attempts to uh, attempts to get the new beta or the new risk, and then the new beta is now used to compute for the cost of equity. So so we use the unlevered beta. So the unlevered beta represents the firm's business risk. So wala pa ang unlevered beta is a risk nga wala pa siya liability. Now, if you can recall, when we discussed the capital asset pricing model, so katong first ninyong finance nga subject, okay? So so Finman 1 or sa other syllabus it's Finman 408. So if you can recall the capital asset pricing model, so di ba we determine the cost of equity by adding the risk-free rate plus the beta multiplied by the market risk premium. Okay, so kanang beta, that represents the market risk, okay, or the volatility of the market prices for that particular business or industry. So, so to get the levered beta or BL, so we have to multiply the unlevered beta or the beta nga wala pa'y inclusion ang financial risk multiplied by 1 plus the unahon sa multiply after tax rate times the debt to equity ratio. Okay, so debt to equity ratio times after tax rate plus 1 multiplied by the unlevered beta. So suppose the risk-free rate is 6% and the market risk premium is also 6%. So ang market risk premium is the difference between the market rate and the risk-free rate. So the risk-free rate and the market risk premium is the same. Now the unlevered beta of the firm is 1.0. So we were previously told that the invested capital was 2 million. So dapat ang total sa imong debt o equity will still be 2 million. So for example, letter D, if D is 250, so you borrow 250,000. So this is the new levered beta or the levered beta for a borrowings nga 250,000. So this is the unlevered beta 1.0. So 'di ba kung i-total nimo ang debt ug kani it will equal to 2 million because some of the 2 million is now financed by debt, the rest is now financed by equity. Multiply the debt to equity ratio by 60% or the after tax rate plus 1 and then multiply the result ani sa 1.0 or the unlevered beta. So the levered beta is 1.0857. So if you recall, the cost of equity or the ROE is also 12%. Okay? But because of the debt financing, so we expect nga taas na ang iyang cost of equity. So risk-free rate using the capital asset pricing model in getting the cost of equity. So risk-free rate niya 6% plus 6% multiplied by the levered beta 1.0857. So the new cost of equity is now 12.51%. Okay, so let's have another. Wala na di ay. So table na. So if you try to compute for the levered beta of each, so let's say 500,000. So you simply change this one. So kani 500. So ang remainder sa 2 million is 1.5. So what is now the new debt to equity? So kani i-change lang ni. So kung 500 ang borrowings, 500,000. So simply change the debt to 500 over, of course, ang mabilin sa 2 million is 1.5. So what is now the new, what is the levered beta for a borrowings of 500,000? Okay, so you should get mga 1.19999 or round it off to 1.20. Now for the cost of the new cost of equity, change lang ni siya to 1.19999 or simply 1.20. Okay, so the new cost of equity, if we increase from 250 to 500,000, is now at, okay, so 1.20 times 6% plus 6%. So the new cost of debt, I mean the cost of equity is 13.20%. So same with 750, i-change lang ng debt to equity and 1 million. Okay. So the table is here. So 1.0857 atong levered beta sa 250, it is rounded off to 1.09. So as we increase our borrowings, the levered beta is increased because of the additional financing risk. And of course, the cost of equity will also increase due to the additional financing risk. So as we have, I have already said gaina, the optimal capital structure is the financing that minimizes the WACC or the weighted average cost of capital, and it maximizes the stock price. So both methods yield the same results. So just to refresh you again sa pagkuha ang WACC, so simply divide the proportion. So 500,000, for example, 250, i-divide na siya sa total financing 2 million. So that would be the percentage for the debt ratio or debt to capital ratio. So 12.50, and the remainder of the 2 million, so 1,750 divided by 2 million, so you have 87.50. So we already have the cost of debt. So i-multiply lang nimong 12.50 sa RD plus the result or the product of the equity times the RS, okay, or the cost of equity. So gayon na at the start, zero ang amount borrowed. Therefore, wala tay debt ratio, but we have equity ratio, 100%. We have computed that the cost of equity is 12%. Therefore, the WACC is what may lain. So therefore, the cost of equity is already the WACC. So for amount borrowed, so 12.50 times the cost of debt, the RD, plus the product of the 87.50 times 12.51. So weighted average cost of capital is 11.55%. So same with the other borrowings. So 500, 750. So mo na ilang mga proportion. 750 and 1 million. So take note also that it is not wise to borrow at 1 million. So na ay financing risk pero the WACC is still the same. Okay? So the extremes are not the ideal way to finance the business. So di pud maayo nga walay liability, dili sad maayo nga ato nga is liability. So as we computed the WACC, we found out that the lowest WCC is at 11.25%. So siya ang lowest, tanawan nato unsay mixture sa debt o sa equity. So the ideal structure is 25% coming from financed liability, 75% will be financed by equity. Okay, so now that we know already uh, the WACC, so if walay lain, kung walay ma-change, same ra gyapon ang cost of debt, same ra gyapon ang cost of equity, then we have to maintain nga dapat 500,000 ra ang i-borrow or ang maximum nga i-borrow. And then the rest 1/5 should be financed by the shareholders. Okay, so it is said that katong pinakaubos og weighted average cost of capital will also lead to the highest stock price. So so we can use the formula kato bitawng getting the value of the stock using katong zero growth model. Okay, so the zero growth, so gitawag siya zero growth because all the earnings are paid out as dividends. So walay mabilin para sa expansion, walay mabilin niya earnings para sa other projects. So all earnings are paid out as dividends. So to get the value of the stock, so you can use the following. So the dividend over the rate or the cost of equity minus the growth rate, or simply you can use the EPS or the earnings per share over the cost of equity. And since all the earnings are paid out as dividends, you can alternatively use DPS or dividend per share over the cost of equity. So let's find the expected stock price. Okay, so to get the stock price, so divide nimo ang DPS over atong RS nga atong na-compute. So mo na result sa stock prices, and still ang pinakadako na stock price is 26.89 each. So the financing or the capital structure that will maximize the stock price is katong capital structure that will be financed by debt at 500,000. So same with our computation gay na sa weighted average cost of capital. So what debt ratio maximizes the EPS? So kung maximization, so of course ang pinakataas nga EPS is at 3.90. So katong nagborrow taog 1 million. However, the debt to capital ratio is 50%. So that 50% is already too high. So taas ang cost of capital ana. So katong gain na that's ang gi-show na ko katong table. It's actually uh, based on Campus Delhi's optimal capital structure. So the PO or the stock price or the stock value, lahi ang market price, lahi po ang valuation, the true value of the stock. Maximized at 26.89. So the debt to capital is 25%. So the optimal debt financing should be at 25%. So kaya ang debt is 25%, it follows that the equity ratio is uh, the, uh, the price is maximized at the equity ratio of 75%. EPS is maximized at 50%, but our primary interest is the stock price, not the expected niya EPS. So if you recall in chapter 1, so the overall goal of the financial management is to maximize the shareholder wealth maximization, okay, or the shareholder wealth. So we can increase the shareholder wealth if the stock prices have increased. So we can push up the EPS by using more debt, but the risk resulting from the increased leverage offsets the benefit of higher EPS. So what if there were more or less business risk than originally estimated? How would the analysis be affected? So kung gain na, kung ang business risk daw kuno is mas nisaka or mas niubos, especially ang business risk is dili na siya constant. So every now and then pwede nga mag-increase. So for example, karon nga situation, a lot of businesses have increased the business risk. So how would the analysis be affected? So if there were higher business risk, so then the probability of financial distress would be greater at any debt level. So kung itaas ang business risk, then the optimal capital structure should be the one with the lower or less debt. However, if the business risk is now lower, it would lead to an optimal capital structure with more debt. So we can afford to have more debt because the business risk is now low. So how would these factors affect the target capital structure? So sales stability. So of course, if the sales is stable, we can afford to have a capital structure with more liability. However, if the sales is not stable, then low uh, the debt financing. High operating leverage. So the high operating leverage will increase the business risk. So the optimal capital structure is the one with a lower financial risk or lower debt financing. If there's an increase in the corporate tax rate, so kung mataas ang corporate tax rate, dako ta og ma-save sa tax kung naatay financing. Okay? Naatay debt financing. So if there's an increase in the corporate tax rate, so uh, perhaps the business would like to have a increased tax saving by increasing the debt financing. Increase in the personal tax rate. So katong dividends from the shareholders, these are also taxed individually sa ila. Okay, so if there's an increase in the personal tax rate, much better if we shift to a more debt financing capital structure. Okay? Increase in bankruptcy costs. Okay, so if there's an increase in bankruptcy cost, of course, high business risk and even high financing risk. So the optimal capital structure should be the structure that has a lower debt financing. Number six, management spending lots of money on lavish perks. So if you want the management to be motivated or ma-discipline sila to cut costs, okay, and to save money, then the capital structure that will motivate them is to increase the liability. Okay? Kaya usay magsalig man ang management niya kung equity financing, remember that the dividends are not regular. So it's up to them whether to pay dividends or not. So to decrease this habit or behavior, so an optimal capital structure uh, that will motivate the management to save money is to increase the liability or debt financing. Financial flexibility, so it refers to the amount of cash nga naa sa business. So more cash, okay, so you can afford to have more financing. Liability. So lower cash, low on cash, then um, more on equity. Firm's growth rate. So as we know, the financial leverage can increase further the profit or the ROE if the situation is good. So if the firm's growth rate is increasing, then the capital structure should be the one with the higher debt financing. Whereas if the firm is declining or the business is declining, therefore dapat mas dagan ang sa equity. Okay, so now we are now on the last subtopic. So these are the different theories about the capital structure. So the first theory is the Modigliani and Miller. So they have what we call the irrelevance theory. So ang ilang concept is gikan sa kanang nakuha nila nga concept sa pie. So, um, according to Modigliani and Miller, so regardless kung giunsa niya to paghiwa ang pie, okay, whether it's 4 or 8, you will still get the same cost, or you will still get the same cost of capital. So for them, identifying the optimal capital structure is useless. However, kaning nga theory is only correct or only um, relevant if their conditions are being met. Okay, so dagan to sila condition. So if you read the conditions, so mo to dapat ang i-met nga situation before the irrelevance theory uh, can be accepted or can be used. So one of that condition is that the investors have the same information as the managers. Okay. In reality, it's not always the case. So most of the time, it's the managers who have the most information or who have the best information compared to the outside investors. Okay, so that's the main problem of the irrelevance theory. Another theory is the signaling theory. So the signaling theory, so ang one condition ato nga wala sa Modigliani and irrelevant and Miller is that the management has the better information compared sa investors. So kung compared sa duha, so I think si signaling theory ang mas medyo dool-dool sa reality. So the signaling theory suggests that firms should use the less debt than suggest. So the unused debt capacity helps avoid the stock sales, which depress the stock price because of the signaling effects. So unsa man ni nga mga signal ang pasabot? So the signaling theory have these following assumptions. The managers have better information about the firm's long-run value than the outside investors. So which is, I believe nga, managers should always have a better information. Second assumption, which I don't think nga medyo kuan siya, correct all the time. So managers act in the best interest of the current stockholders. So what can managers be expected to do and unsay signal nga ilang ihatag sa investors? So sa signaling, if the managers think that the stock is overvalued, so overvalued ang market price sa stocks as against the intrinsic value, so the managers will issue stock, additional stock. Okay? Siyempre para uh, makakuha pa sila more financing. They are taking advantage of the high market price compared sa true value sa stocks. So unsay hunaon sa investors. So if the investors understand this behavior, nga nag-issue ang manager og stock, okay? The investors will think nga ang shares nga iyang gihawiran is overvalued. Okay? So kung overvalued, most probably the investors will sell the stocks. Okay? So they will sell the stocks. And therefore, pag ilan ang sell, so mas daghan ang mubaligya kaysa sa mupalit, it will cause the stock prices to decrease. Second, behavior of the managers that the investors are observing is every time nga mag-issue og debt, so the managers only do this if they think the stock is undervalued. So if the stock is undervalued, then um, the investors will think nga yes, the shares nga akong gihawiran is undervalued. So best decision nga hibuhaton nila is to buy more stocks. So it will increase the value of the stock prices until it reach the intrinsic value. So as a result, the investors view a stock offering negatively. So because of according to the signaling theory. So managers think the stock is overvalued. So For the investors, issuing additional stock is a signal nga their stocks are overvalued, and if the managers will issue debt, the investors will think that their stock is undervalued, therefore they will buy more. So conclusions on the different capital structure theory. So there's a need to make calculations as we did, but all of those are inputs are what we call the guesstimates. Okay, so guesstimates, not really the most accurate. As a result of the implied numbers, capital structure decisions have a large judgmental content. So every financial manager, so dili siya mag the theories serves only as a guide, but not really the 100% correct all the time. So it depends heavily on the judgment of the financial manager on what how the capital structure should look like, on how are they going to finance their business, either from debt, from preferred or equity. So it is heavily based on the judgment of those financial managers. So we end up with capital structures varying widely among firms. So all businesses are different, all their situations are different, their financial situations are different. So all of those things must be considered in coming up with the right mixture or the right capital structure for the business. Okay, so that ends the discussion on the capital structure and leverage. So if you have questions, clarifications, so please ask it now.
Question, Carlo.
Question na din. Time.
Sir, na question si Kwan, sir, si Roland.
Okay. Sige, Roland.
Ay, gikan ni kang Roland, sir, yung gichat sa ako, ha.
Mm. Mm.
Kwan, sir,
Sige, sige.
if, anang, if given na ba ang weighted average capital, sir, if given na siya, sir, pwede ba, sir, nga figure mismo, pag yan, i-ignore ato ang EPS, ang interest earned, if ay WAC,
So
ay,
medyo
itong WAC, i-cover naman good to ang
medyo
kuan,
putol-putol, Mark.
ay,
Balik ka daw ang question.
if given na ang weighted average of capital, sir,
Oo. Oo.
gina-consider pa ba tong laing figure, sir, as itong EPS
Of course,
o
TIE. Actually, depende magud na siya sa question, sa problem. Kaya nabay, 'di ba, kung kabantay mo sa mga question sa financial management, so they always ask ka ng mga relationship sa mga ratios. Like for example, unsay impact pag inani cost, unsay impact pag taas ang EPS or taas ang si tawag gani. So for example, kung more borrowings, time na question nga inana, what is the effect to the EPS or the TIE? So mga inana ang question. So this the questions daghan magug posible ipangutana. But most of the time akong nabatikdan is you should know how what is the relationship of uh, this factor to other ratios. Okay, so unsa impact ani sa TIE, unsa impact sa kuan, so mga inana nga kuan. So manang be ready gyapon mo. Okay? So pero kung naanay gihatagan na mo given nga WAC, of course you don't need anymore to compute, 'di ba? Maski gihatagan mo proportion sa cost of debt, hatagan na mo proportion sa equity, pero kung naanay gihatag nga WAC, there's no need anymore to kuan. So as ang imong question is dili na ba kung naanay WAC dili na ba kailangan ang EPS o TIE? So it depends on the problem. Depende na sa pangutana kay. What if ang pangutana is unsay relation sa WAC sa EPS or unsay may tabo sa for example kung mag-increase ang borrowing, unsay impact sa WAC, unsay impact sa EPS or TIE. Okay? So I cannot really say nga dili siya kailangan. It depends on the problem. Kung unsay ipa-answer, okay? Pero mo na ako na matikdan, so you should know how to understand the impact of kuan sa different nga ratios. Okay?
Sige, Carlo.
Kon sir. Kanang compared bitaw sa short term sir nga ang financing unsay kanang mas benefit sa long term nga financing sir?
Kung ibase na ko na sa personal finance, kay usahay mo gud ang personal finance og sa mga corporate financing is somehow similar ang kuan niya. So of course kung short-term financing, ang imo i-finance of course or ang imong gamitan is mga short-term lang nga goals sa corporation. Okay? So as a conservative financing, inana gyud dapat. Okay? So short-term imong financing, meaning it's only good for 1 year or less ang imong bayaran ana. So the goal should also be the same. Okay? So it's also short-term goal ang i-finance sa short-term. If it's long-term nga financing, ang gamitan niya is dapat katong mga investment nga for long-term. So like it involves large sum of money and the asset can be used for a long period of time. Okay? So inana gid ang what we call the conservative financing. However, there are types of financing like mga moderate or aggressive financing nga even though the goal is long term pero ang i-finance nila is short term. Okay? Short term financing. So of course that the higher the aggressiveness sa pag-finance, the higher pod ang risk. Okay? So pag mingon kay tag higher risk, unsay naagi na siya kaluha. Okay? So the higher the possible return. Pero in financing there should always be a balance between the two. So depende na sa financial manager. Unsay mo nagingon niya, it is largely dependent on the financial manager sa pagtimbang-timbang niya unsay mas makaayo for the business. Kaya naiuban nga gusto mag-aggressive financing para magpa-impress sa investors. Okay, some investors would really know nga ay kani aggressive ni nga mo finance. Dako nig return in the future pag mo succeed ni siya. Okay. So, inana na siya. Usually ang magpakitang gilas kato mga dili pa kayo ingon niya kumbaga di pa kayo siya ingon niya established in the business or in the company. So sila tong magpakitang gilas sa investors. Pero katong mga established na nga companies na proven na nila, they tend to become more conservative in terms of financing. So there are benefits of being conservative, of being aggressive, napod na siya downside.
Ang kuan sir, ang maklaro ba sir?
Sige.
Di ba always ang target ka atong gidiscuss karon kay para ma-maximize ang kuan shareholders wealth
Oo.
through showing nga ang stock price magtataas. So, kuan ba sir ginay-feel ba na sir na ang ginabuhat sa company will be limited lang sa murag short na time horizon since ang goal lang man kay itaas ang stock price. So, dili ba na ma-short-sighted ang ika company since puro sa man stock price ang gina-consider or naiuban nga long term ang gina-consider nga bahala moubos ang stock price for how many months pero maabot nga month mo taas sa gihapon.
Mm. Okay, so that's a good question actually, no? So, of course, in Animanggo, there are two types of investors in the stock market. So, natin ginatawag ng mga fundamental analyst, na po yung mga technical analyst. So, for technical analyst, ang ilang concern is the price. They don't mind about the situation inside the company. Ang ilang gina-monitor agad is ang price. So, katong capital structure nga makita nila nga ni kuan ni taas, let's say the stock price lang ani taas, mo na i-consider mo ra na ikuan nila. Kumbaga, that's the point where murag monitoring ra sa price. Pero kung fundamentalist ka nga investor, you would know nga imo pa nang i-check whether kanang decision sa management is for short term or long term. Long term ba na siya nga effect based on the financing. Kay before, especially mga publicly listed entities, before sila maka-issue og stocks or na sila mag-issue og bonds, for example, naman na sila disclosure nga ihatag sa public as to unsay gamitan nila. Okay? So based on that disclosure, mag-decide ang mga investors whether if it is for short term or long term. Okay? But of course, ang managers, as we know, naagi na siya agency conflict. Okay? So sa agency conflict, especially kung nakabase ang iyang performance sa sa based sa kanang stocks or sa value sa ilang stocks. Okay? So kung dira nakabase, the manager would do something nga mo mubuhat ana even though it's only short-sighted. But that is why very important nga naagay board of directors that will supervise the the kanang behavior sa management or ang iyang gitrabaho. O dapat na apoy system nga or reward system nga maka-prevent ana. Okay? So reward system nga dili mag-reward og mga short-sighted nga or mga short-term lang nga result but will reward them with long-term impact sa iyang ginabuhat, long-term nga decision. Okay? So mo na siya. Okay? So as to financing, mo na siya ang murag technique, strategy sa mga financial manager to increase the stock price. Okay. Okay, so some more questions.
Answer. Kanang long-term financing man, sir, na. So,
Mm.
ako mapansin, sir, ba kayo, why nga always lang bonds ang ginagamit for long-term dili? Wala, anang, like for example, dili pwede ang mga long-term note, mga non-interest bearing notes, sir.
Actually pwede man, kaso ang textbook manggod ni Kuan, ang textbook manggod ni Brigham is focused on the bonds. So bonds manggod ang long-term nga mga instrument as well as katong stocks. So other interest, other pay liability such as kanang imong giingon yung mga loans. So mas mo prefer man gud ang corporation og issue na lag bonds kay sa long term nga mga loans man gud nana siya limit nga pila ray pwede nila ma-loan. Okay? Aside from na limit sa amount nga pwede nila ma-loan, perhaps the interest is higher compared sa kung mag-issue na lang sila og bonds which is more kuan, 'di ba? Dagay tao then dako ang capital nga ilang ma-raise and then the time or the maturity that they will pay is probably longer ang term. Longer ang term. So muna nga medyo nakafocus kay bonds. Okay. Pero of course the business can avail other liability dili lang kay bonds. Okay. Ang imo lang tan-awon sa interest, I mean sa mga liability or long-term notes is the effective interest rate. So compare lang gina nimo. Okay, but sa Philippines, I think wala kayo usually ang mag-issue ra mag-bonds kato ra mang yung mga dagko na nga mga corporation, but uh, for mga dili ina na kadagko nga mga negosyo, so most of them will resort into loans. Mga long-term loans.
Di man
Okay.
tanan business sir no allowed mo issue bonds.
They have, yes, kailangan pa na siya sa, mo-undergo pa man gud nagkuan sa SEC. Anang kumbaga, mga pa kag permission, mag-submit pa kag kuan. Pero dapat magpa publicly listed sa ka. Kaya ka maka-issue og bonds. Because it involves a lot of kuan naman, people, bondholders. Okay?
Dapat ba na limit na sa income sir? Para maka-issue
Ah,
og bonds. Anang
na-limit sa income,
ay kanang murag anang amount sa imong bond sir ba? Capital na
requirements.
oh, para maka-issue og bonds.
Of course, nagi na siya yung kanang qualifications. So, actually si SEC naglatag na siya og mga requirements. So, nga dapat i-met sa mga corporation para maka-issue sila og bonds. And then of course, the SEC will protect the public. So, mas kuan ang ilang interest sa public. So, I think murag na sila ginatawag nga magkuan is one of their condition is dapat na ay sinking fund. Okay? So, dapat maka-establish sila sinking fund before they can issue bonds. Okay? So, dapat ipakita lang yun po ni ni company nga kaya niya pangatawanan ang ilang i-issue nga bonds, kaya ba gina nila bayaran in that at maturity, kaya ba nila bayaran ng interest. So of course the SEC will ask for the financial statements and their FS analysis. Pero as to amount, it depends on its the capability of the company. So wala siya ingon nga limit nga kanilang, it depends on its kaya niya bayaran. Now what is ang trend karon, usually di na sila mag-issue og bonds, mag-issue na lang sila og preferred stock. Okay? Kaya ang preferred stock murag natay ginatawag nga perpetual bonds, okay? Perpetuity bonds. So sa imong amount nga gikuan, so eternal ambot na ko tinuod ba gyud nga perpetual, kay I have not really seen the kuan. Pero according to them, it's perpetual bonds because walay maturity na kabutang sa ilang certificate. But ang risk lang ana is naay nakabutang manggo dito nga ang company ang magbuot kanus ana taman niya nga kuan nga security. So misnomer kayo tawagon siya perpetual bonds if the condition ko kanus siya taman is in the hands of the the issuer. Okay, but it's an alternative to bonds. Mas dako siya og return. And then it is like a liability also kay regular man maghatag og dividends. Then dako ang dividends nga gina-provide. Okay. Okay, so you have good questions. Okay, so how about the others? Can you use the chat box ha? Sorry nga mogamit mo sa mic.
Unsa may next meeting na to, sir?
Hmm, sa ang sunod na to nga topic, so para kuha mo daan, derivatives and risk management. Okay, so next topic na to is derivatives and risk management. Actually, no, ako na-realize na nga, mas makasabot ko og financial accounting kung mag-una ko basa sa kuan. Financial management, kina dito ang mga securities nga wa gid ako masabti sa financial accounting, like the valuation of the bonds, the stocks. So okay, usually mo good sa financial accounting kay diretso ra og small description pero computation na dayon. So we don't even know the rationale behind those formula. Okay, so that's the second topic, derivatives and risk management. Now for ako na lang i-send sa inyo ang kuan about sa financial markets. Okay, so medyo taas-taas siya. Part 1, part 2. Kay tanan mo akadi nga akong gi-discuss is the money and capital markets for the Philippines. Okay. So basin man good niya ma-appeal sa inyo ha. So I'll just send the link. So ikuha na lang ninyo i-copy or i-bookmark.
Sige, sir.
Pero we will still discuss this. Napatay koan. Okay, so I think nawala naman siguro yung question, no? So again, thank you for coming. Thank you for listening. So see you on the next topic. Okay, so same time Wednesday. Okay, so paningkamutan ako nga 1 PM na ta para kuan. Sayo. Okay.
Sige, sir.
Okay, so
Salamat,
thank
sir.
you. Mm-mm.